After World War II, we had a record amount of people born in the Western world. Those people, their journey is the story of our economy. The growth go-go years of the 50s and 60s, the inflation of the 70s driven by all of these people coming into the workforce, earning an income and competing for goods and services. Then the 80s and 90s, then the 80s was them financializing. They get to their 30s and they start buying financial assets. That starts moving the price of assets. By the time we get to the 90s, we start to bring other people into this global labor force. So not only have we got a record number of people competing for jobs, but we also then bring the WTO agreement and we start bringing everybody from China to Mexico to Vietnam into the labor force. That means that wages never really went up in real terms. Yet, because people are investing in their 401ks, assets were going up. So that was the start of the great asset unbalance. What happened was, over that period of time, people started taking on more and more debt to fund the difference in the asset price rises versus their wages. And that kind of makes sense. You borrow money to invest in the future. But that got out of control. By the time we got to 2008, the debt side of the equation was literally ridiculous. Every major economy was pretty close or above 100% of GDP in debt at government level. Households were at record high debts. Corporations were at record high debts. And then the world stopped. You see, what happened in 2008 was the value of the collateral of the system started falling. And that was when the equity market starts falling. The real estate market was the real one. That was huge amounts of collateral with massive amounts of borrowing. The collateral falls, the borrowing becomes unsustainable, the whole system imploded. Now, the banking system itself was record leveraged. And what happened was this complete meltdown of the global financial system. And looking back now, I now think that this really was the 1929 moment. But it didn't turn into 1929. And there was a reason for that. Is we had Bernanke at the Fed. And Bernanke had an understanding of what went wrong in 1929. And he had one special trick up his sleeve, which was the use of the balance sheet of the central banks to deflate the value of money itself. And so therefore asset prices optically rose. So that's the denominator effect you've heard me talk so much about. All the central banks agreed pretty much around the same period of time to start printing money, debasing all of fiat currency. Asset prices ripped. If asset prices ripped, well, guess what? The collateral of the system is now saved. So they save the system via this particular mechanism. Now, these are optics. They're not reality. They're optics. And I've spoken before, if you divide any of the assets since 2008 by the Fed balance sheet or global total liquidity or any one of these measures, they've gone nowhere. You see, we've had no real growth. And that led me to start to have an understanding. It was a conversation I had with Jordi Visser, and many of you have now read the Global Macro Investor, the free one I gave out, the annual think piece. And there's an incredibly important article in that, which was 2008, the year the world broke. You see, in 2008, yes, we understand that it broke, but it broke in many more ways. We hit something called peak fiat. And that's Jordi's thesis that I've stolen from him, but it really encapsulates what I'm talking about. That whole fiat currency, debt-driven bubble regime died in 2008. And GDP globally fell. The trend rate of GDP growth ratcheted lower and never rose. But you see, more things happened after 2008 that people aren't really aware of. For example, the dollar has been rising since then. Why? Because the dollar is the global reserve currency. Most of the global debts are in dollars, and there's a shortage of global dollars. And there has been since 2008, and really exacerbated by the time we got to the European financial crisis. So there's a shortage of dollars. There's a shortage of global lenders because of Basel III and the agreements with the banking system. So the dollar rises. Okay, fine. We can deal with that. And that's part of Brent Johnson's dollar milkshake theory. But more importantly, when we look at global equity markets in dollar terms, they haven't gone up. Not only did equity markets peak in 2008, but we also peaked in total debts. The US debt market peaked in the pandemic. We had that extra spike, but really it peaked a while ago. And I've talked about this before, and I'll come on to this in a bit, is the debt growth now is really just offsetting the interest payments. And it's all around trend rate of GDP growth. So therefore, debt is not growing faster than trend rate of GDP growth, really, because it's the missing trend rate of GDP growth that goes into paying the interest payments, and the interest payments are where the debt growth is. Those are the deficits that we see. So debt growth at government level kind of slowed down. In absolute dollar terms, it keeps going up. In versus GDP growth, it's been stable because GDP has fallen over time, and the US central bank has essentially monetized the interest payments on the debt, because if the government's 100% of GDP in debt and the private sector is 100% of GDP in debt, just to give you easy maths, it's actually worse than that, then the private sector with interest rates at, let's call it 2%, that's 100% of GDP growth to fund the interest payments. So who pays the government debt growth? And right now we've got interest rates too high, and GDP growth is not high enough to service them. So over time, we will see some action there by central banks as they have to lower the cost of the interest payments. Because if not, it keeps compounding on the balance. It keeps compounding and eventually lose control of the bond market, and they have to impose yield curve control, or they have to print more money. Both are actually the same mechanism. They're just different ways of printing money. So that is where we are with the debt market. Now, households, they couldn't borrow more money really past 2008. We found that the banks and Basel III and the general agreements between all of the banking systems around the Western world is we get access to less cash. The governments get the access to the cash. They can't let the households keep growing their debt. So it's harder and harder to get debt. Also, asset prices have risen so much that we would have to borrow too much money to actually buy into asset prices. So it's kind of fucked us there. So we've now been fucked because asset prices are rising and we can't borrow money to even get into the property market, but they're also becoming unaffordable because our wages never went up. Okay, so those are the two of the key reasons why we're now, what we need to do is figure out, okay, what does this all mean? Now, what I've shown from all of this is that really the governments have just offset the debt growth via the printing of money. And the balance sheet keeps going up. And that is the debasement of currency effect that is so pernicious. You've got to think of debasement of currency as a hidden tax on everybody. It's basically, if they're debasing currency by using, let's say, total global liquidity, and that's the US, Europe, Japan, China, the UK. If they're debasing by about 15% on average, then we're all getting 15% poorer in terms of our income buys less assets because the assets optically rise, incomes don't. It's also the same mechanisms why PE ratios go higher. The price goes higher, but the earnings of corporations doesn't grow at the same trend rate as the debasement. So we're all unable to afford any of these things, and they have just monetized all of the differences here. We've all become debt slaves because it's been mutualized to all of us. They could have increased taxes by 15%, but they didn't. They did it this way. Now, that's also made the rich get richer because they can own the assets, and the poor get shut behind. It created the populism that I've talked about many times. It's people are looking for somebody to blame. It's actually the baby boomers themselves that are to blame, but obviously, well, their parents for having too many kids after the war. But anyway, there's nothing we can do about that. It is what it is.